Hello everybody, Randy Patrick here. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. It is busy, a lot of news going on, a lot of financial stuff happening. Today's October the 17th. We're going to delve into some housing related news right now. If you're not already a subscriber, my channel talks about the housing market and we share the truth and what's really going on out there. So please subscribe to help my channel grow. Thank you very much. One other thing too, before we get started, I have a report that I've sort of worked on and created. Go Banking Rates is a website that has a lot of interesting stuff on it. They published the 50, I guess you could say, top 50 housing markets that are at risk of a turn or downturn, and I compiled that for you, plus I added a special bonus report with respect to the best reasons why you should be adding short sales to your purchasing or investing repertoire. So if you'd like, you could go to this website. It's housingbubble2.com. So again, housingbubble2, the number 2.com. Click it there. You can actually look at the landing page, click on getting the report. You'll see the report on screen. Obviously, you have to provide your email to get the report. Once it's on screen, you can read it or you can download it to your computer. So if it's something you want to take a look at, it's interesting to see that all the talk about what's going on in the marketplace. There are a number of locations across the country that are on sort of the cusp of having some major housing issues as time goes on. So this is, again, something for your reading pleasure. All right, and by the way, if you're in the Tampa Bay area next week, I have a real estate investment club, a small one that I sort of manage and operate. And next week, we're actually going to have a bigger meeting. I call it the Fall Foreclosure Festival. Talk a lot about what's happening in the marketplace and some of the major changes that I'm seeing in the foreclosure market right now. So we're going to have that at the Hampton in Avion Park here in Tampa from 7 to 9:30 p.m. So I'll talk about this at next week's video as well too. And if you want more information, just ping me and I'll let you know more about it. Okay? Great. All right. Big news, I guess you could say, and I look at things in themes. The Federal Reserve reports a rebounded housing market. So this came out last week. The housing market was the bright spot in the Fed's monthly economic snapshot that was released on Tuesday. While consumer spending softened, I guess you could say the housing market has rebounded, the Fed said. So housing activity indicators displayed further gradual improvement in August, the report said. Single-family housing starts and permits have rebounded over the past 3 months. New and existing home sales rose in August, and a still strong labor market and low mortgage rates continue to provide support to housing. So it's kind of fun that we get to, they say that everything is getting better now because we've had one good month. Favorable labor market conditions and a substantial decline in mortgage interest rates continue to act as positive forces. However, inadequate inventories in affordable price ranges continue to be a drag on sales and to fuel home price increases. So we're going back to, okay, we've lowered rates. We're getting a few more builders coming on, putting some product out there or planning to. We're still seeing housing growth as far as price is concerned. Why? Because of low inventory. So really, as we said before, the lower rates just give you more buying power. It doesn't change the price point of a home, just gives you more buying power. So funny enough, so that was written a few days ago, and then this comes out saying housing market flashing recession signal. So we've just been told by the Fed in the report that the market is rebounding, and then a couple days later, reverse, we're seeing housing market flashing recession signal. So why the gap between home prices and income point to recession by the 2020 election. So this, I think, is kind of interesting. And if you take a look at it, there was a report by the Council on Foreign Relations, and they're definitely looking at what's going on here. And I'm going to give you the graph. Hopefully you can see it. But essentially what they're suggesting is that looking back at the years, when you look at the back of the years preceding the 2008 financial crisis, a critical warning sign was the surging gap between growth in home prices and household income. So we've talked about this many times, and so has other economists, etc., that there's divergence in wage and wage growth with respect to housing price growth. It's getting wider and wider as time goes on. So they cite that when income fails to keep pace with home prices, the latter must fall back. And what they're looking at here is saying a parallel dynamic is playing out. You can see the similar gap. These gray lines here are recessions, and the blue line is housing sales. So basically, every decrease in housing sales volume and activity has been a precursor to a recession, and that's what they're saying. It's kind of like the last time through. If these trends continue, we should expect broad falls in home prices beginning by mid 2020, just before the recession, which will in turn drag down household spending against a darkening economic backdrop. So again, this isn't, how can I put it? This is the Council on Foreign Relations. I guess they do their studies, and I'm not too sure what horse they have in the race here, but I do find this interesting that when you look at all the economic indicators, it's pointing to the recession and pointing to what happens during the recession: reduced spending, people lose confidence, they pull back, and home prices will suffer for that reason. And this is yet another sign, like inverted yield curves and things like that, when these things happen and occur, and when you can measure them, when you look back in history, it shows that there's a trend and a pattern, and we expect this to happen. So basically they're saying, well, how do we stop this? Well, if we are really on the cusp of recession, it will likely take more than 175 basis points of easing to prevent it, and that's all the central bank has to play with before we're back into the zero lower bound. So I guess you could say there's not much there's really left on the table here to prevent a recession, but the indication here is that when housing sales are falling below that line up there, okay, and that trend is just before a recession happens, and it's again, it's not just one recession. We're looking at 2, 3, 4, 5, 6 previous ones where this has occurred. So please keep that in mind. Now, having said that, September home prices for California. So California Association of Realtors released, I guess you could say yesterday, their September home sales and price report. When it comes down to it, if you take a look at the highlights, which we'll get to in a second here, there is month over month price change is down a little bit for California single-family homes and California condos. The year-over-year price change has gone up. So for single-family homes, it went up 4.7%. For condos, and townhomes, it went down 2.1%. So that's kind of your area now. Obviously, you take a look at the chart here, and you can go right to CAR's website and figure it out. But essentially, we're seeing markets maintaining maybe some increase, but it's really the San Francisco Bay Area which is losing. They're basically losing the price point. They're losing the month over month price point change, year-over-year price point change, this monthly sales change, and where it increased was the year-over-year sales of 6.2%. So other than that, you're seeing some, basically, we're still in the 2s and 3s and 4s with respect to price point increases in Los Angeles, Central Coast, Central Valley, Inland Empire, but in San Francisco, Silicon Valley area, we're definitely seeing drops there. And that's a key point here. All regional level medium home prices rose from a year ago in all regions except the San Francisco Bay Area. Bay Area is experiencing year-over-year price declines for 8 consecutive months and 9 of the last 10 months. There you go. After 15 straight months of year-over-year increases, active listings fell for the 3rd straight month, dropping 11.8% from a year ago. This decline was the largest since 2007. So, inventory is actually decreasing now because people are buying. So, it's one of those things where you had to expect something was going to happen in September. It did. There was a little more activity than probably planned. And that's great for people trying to sell their homes and great for people trying to buy. Certainly, it was low interest rates that would have given people that a little extra time or a little extra room to jump in and actually purchase something. So again, unsold inventory was 3.5 months in September, up from 3.2 in August, down from 4.2 months in September the previous year. So less inventory than the previous year. Obviously, when sales go up, you have less inventory. So that's kind of it there. Again, you can go to the CAR's website and take a look at the detail. It has it broken down by more counties. There's 90 some odd, I guess you could say MLSs or counties that report the information. So obviously too much to put on here, but just in summary, obviously, single family home sales are up slightly, price almost 5%. California condos actually, price is moving downwards on a year-to-year and month-to-month basis. So there's a little bouncing going on there. Okay, this which takes us to the nation's hottest home flipping markets. Might surprise you, and this is actually produced by Realtor.com, and they put out a report that gave us the number, or the top 10, I guess, the hottest home flipping markets in America right now. And apparently, this is a big surprise, and that wasn't on my radar as well too. So the number one, I guess you could say, recently, best home, I guess you could say home flipping location is actually St. Louis, Missouri, and median home price is $189.9, and basically, a lot of stuff going on there. So I guess that's, it's right in the Midwest, reasonably priced, so it's going to attract a lot of people to invest and purchase and buy and sell property, and improve and rehab, etc. So that's it. Rounding out the list was Birmingham, Alabama, Miami, Florida, Tampa, Florida, Memphis, Tennessee, obviously Las Vegas, Phoenix, Orlando, Florida, Columbus, Ohio, and Philadelphia, Pennsylvania. So those are your top 10 hottest home flipping markets as per Realtor.com. And typically Adam Data Solution puts out this of information, so it's not out as of yet. And a lot of these locations are going to be on the Adam Data list as well too. So how Realtor.com pulls their info, and how which could be basically sales from MLSs is how I look at it, whereas Adam Data Solutions would typically pull information on all transactions, include MLS and off market as well too. So that's why you may see some differences there, but this is primarily, I would imagine, based on the MLS reporting that they've got their hands on. So there you go. Which brings us to right now, funny enough, we have the foreclosure activity. So Adam Data Solutions did produce the Q3 foreclosure activity for 2019, and what they said here is that the activity is down 19% from a year ago to its lowest level since Q2 2005. So please realize that although this is encouraging, sometimes the headline is not as descriptive as it should be. Foreclosure activity, includes filings, notices a default, and includes auction sales and things like that. It doesn't, it doesn't always, how could I put it, paint the most accurate picture as far as I'm concerned. There are people who could have done loan modifications that stop their foreclosures. There are people who could have deed in lieu, do short sales, things like that. So realize that there's not always, it's tough to look at this statistic and try to figure it out because there's so many components to it. But in the end, we've known that since the last housing crisis, we're going to see, a lot less of this stuff going on, which is fine. So when I take a look at some of the information here, again, so you see a decrease in overall activity. That was my point there. But I like to focus on foreclosure starts. So foreclosure starts are down nationwide, up 30% in local markets. So basically they say, well, bucking the trend of decreases, is down 8% from the previous quarter and down 15% from a year ago, which is fine. But counter to the national trend, 14 states posted a year-over-year increase in foreclosure starts in Q3 of this year, including Montana, Georgia, Washington, Louisiana, and Michigan. They were up 33, 32, 16, 15, and 12% respectively. Also counter to the national trend, 66 of the 220 metropolitan statistical areas analyzed in the report, roughly 30%, posted a year-over-year increase in foreclosure starts in Q3 2019. Now, the previous quarter, we had over 40% year-over-year increases. Now, I do know that sometimes the foreclosure starts they kind of ebb and flow a little differently, and sometimes they're seasonal. I didn't expect to see as much of the summertime, just quite frankly, because I find winter and spring they rise in the fall. Kind of in the summertime, there's people are on vacation, so lenders aren't filing these things, the lawyers aren't filing them at the same pace, whatever. So you're not going to see the big numbers across the board, but still 30% posted year-over-year foreclosure increases. Those markets with at least 1 million people who posted an increase was Atlanta, Georgia, up 37%, Columbus, Ohio, up 27%, San Antonio, up 24%, Portland up 22%, and Tucson, Arizona up 21%. So you can see that these are kind of locations that maybe don't always appear on our radar with respect to, oh, these are going to be areas that are losing value and having a hard time, etc. Because you can still have an increase in foreclosure filings, still have strong values. It's just a segment of the marketplace and the population who's having difficulty paying their mortgage, and we're seeing that go up. Now, when we take a look at the national trend, 30% of these metros are posting year-over-year increases. Well, I said it was over 40% last quarter. It's not 5 or 10%, it's 30% and 40% previously. So it's not like that this is down to nothing. And it seems that we're being consistent with the foreclosure starts over the past few quarters of being at least 30%, if not higher. So, but I always notice that, sometimes these, like a San Antonio or a Portland or a Tucson, which maybe weren't on the radar last report, bang, they get up into a report because they've had, for whatever reason, a surge in filings, and there could be a number of reasons for that. But it's just interesting to see how different cities will ebb and flow. But noticing that more cities are sort of making this list as time goes on. So the highest foreclosure rates are in Delaware, New Jersey, and Maryland. So nationwide, 1 every 946 properties had a foreclosure filing in Q3. States with the highest foreclosure rates were Delaware, New Jersey, Maryland, Illinois, and Florida. So that's number of filings per housing unit. All right. Now, that's the state level. Among the 220 metropolitan statistical areas analyzed in the report, those with the highest foreclosure rates were Atlantic City, New Jersey, Trenton, New Jersey, Rockford, Illinois, Fayetteville, North Carolina, and Peoria, Illinois. So we can see there's a little bit of, I guess you could say, Illinois, New Jersey kind of having, I guess you say higher volume with respect to the metros, and that of course relates back to Illinois and New Jersey being the top 5 for the states as well too. So just realize that again, different cities are going to ebb and flow with this. As I always say, some states just tend to have a lot of this going on. So if you're looking to purchase a property or look for an investment opportunity, I would go personally to the states where you see a lot of this is happening. You've got a better chance of grabbing a potential distressed property or short sale. There you go. All right, what else do we got here? And average times to foreclose see an uptick, which is interesting because typically the trend from start of filing to actually foreclosure sale has been going down, and there's a number of reasons for that. So back in the day when we had so many of these foreclosure filings going on, there was a lot happening, okay? And the lenders couldn't keep up with the volume, and the court systems couldn't keep up with the volume, and the clerk of the court who posts all these things can't up, and the auction site. So it's all related, and there's a lot of activity going on. It burdens the system. Well, things are better these days, okay? There's better systems, better data, everything's online so that it's smoother. But properties foreclosed in the process had an average of 841 days, which is up from 716 days in the previous quarter and up from 713 days in Q3 2018. It's the highest level since Q4 2017. So I think that's interesting that there is an increase in the time to foreclose. States with the longest average foreclosure timelines in Q3 were Indiana of 1,600 plus days, Hawaii 1,600 plus days, Nevada 1,500 plus days, New Jersey 1,100 plus days, and Georgia 1,100 plus days. So if you think about that, dividing almost 1,200, well, actually no, 1,600 here by 365. So you're looking at almost 4 years for Indiana, almost 4 years for Hawaii. So that's the average timeline. Well, I can tell you that is actually changing. And that's what I wanted to point out, which I think is very unique in the foreclosure market right now, because clearly I track all this. Obviously, I'm looking at this market. We're trying to acquire properties that are in this process. And what we've noticed, and this is within my own local market here in Tampa, Florida area, but I don't know whether this is indicative of other parts in the country, but a couple of things are happening right now. So number one, we know that the lenders are, as I said earlier, better equipped with better data, better systems. They're more aggressive. They look at this as a money-making opportunity as opposed to mitigating disaster and just trying to plug the holes. So they're more interested in moving these things along a little quicker now. We also know that from studies and conferences that have been out there on the whole mortgage bank lending servicer side, we know that those groups are experiencing an increase in loss mitigation activity, and all of them have planned to beef up their loss mitigation back office and activities starting the second half of 2019, which we're in right now. I've talked about this before, but so they see what's going on locally. For us here in the Tampa Bay area, we are seeing, going to foreclosure sale right now, filings that have taken place this year in 2019. So when I pull my foreclosure list, I look at what's going to go to foreclosure sale at the county auctions, the upcoming, the next 4 weeks, 5 weeks, whatever. I'm seeing a lot more 2019, we'll call it case numbers on those dockets to be foreclosed on, which to me that's bucking the trend. Like, I know that Florida's probably about it wasn't the top 5 with respect to the average foreclosure timelines, but I know it's up there. It's typically around 900 to 1,000. It ebbs and flows, for how many days to foreclose, in at least in Florida as a state. But again, noticing locally here that a lot of these homes are going to foreclosure faster. So the concern is that the homeowner believes that, hey, I can stay in my home and not pay my mortgage for God knows how long. So again, you don't pay your mortgage for a certain period of time, so you're not paying. Then the lender does the foreclosure start. They initiate the notice of default, or they issue a foreclosure litigation suit against you. And then the foreclosure timeline that we're talking about here starts, which could be 3 years, 4 years. So people can actually, milk the system pretty good. That's changing now, as I mentioned. So I've seen a lot of these homes that are, as I said, filed earlier this year, already on the schedule to go to sale. And I can tell you that a lot of the homeowners are thinking, I thought I had 2 years minimum to sit here and do nothing, 2 or 3 years. Well, you don't. And because of low inventory, because of the fact that lenders realize that they can make their money back faster by selling at the auction, lenders realize that, well, if they do take the property back as an REO, they could package them in non-performing loan pools and sell them to large investors and hedge funds and whatever. Every so often, Fannie Mae puts out their non-performing loan pool sale. Usually they're hundreds of millions of dollars worth of mortgages, if not billions. Sometimes they're over $1 billion as pools that they try to sell. So they're trying to flush this stuff out. They don't want to hold on to it. If a lender holds a foreclosure, it costs them money to secure it, to cut the grass, to winterize it, depending on where the home is, to maintain it, to check on it, to make sure there's no vandals or squatters in there. So it's time and money. They realize, let's get rid of these things faster. So we're starting to see trends now of moving these things through the system a lot quicker than they used to be, and that's gonna take a lot of people. It's gonna catch a lot of people by surprise. So adjust your thought process, your marketing, your business plan accordingly when you're working on these deals here. So we've had to as well. Okay, and this sort of ties into this right now. Citibank was fined $30 million for holding on to foreclosures too long. If we go down the path of why the housing recovery occurred from the last housing crash and our lowest trough point in 2011 and 12, as I said, it's not because of fabulous wage growth and the economy is so good. It's purely based on controlling the inventory. Well, the banks do that, the hedge funds do that, everybody does that. We can't, as normal people, get access to these things and purchase them. So Citibank actually received a fine of $30 million for holding onto their foreclosures too long. And I guess there's a couple hundred properties that they're looking at here, but I didn't realize this, but there's a 5-year REO limit that is out there. So the Office of the Comptroller of Currency basically mandates that a lender cannot hold on as an REO a property for more than 5 years. So why they would hold it for more than 5 years, I really don't know, but they've got their reasons for it. There was a couple hundred of these, as you can see. I don't know what the per property fine is, but they fine them, which is kind of good. So let's hope that some of these properties move more, which means they're going to come back into the marketplace and help with inventory and possibly lowering some prices. But again, I did think that was interesting. So obviously this is probably a gross misrepresentation of the 5-year rule. That's probably why they got dinged for it. So obviously it had again, they obviously had their internal issues for whatever reason, but I don't know of any other banks. I haven't heard this for a long time of banks being fined for REOs. So again, a 5-year limit's quite a long time. I think that should be reduced, to be quite honest with you. All right, and sort of rounding out today, Mortgage Bankers Association, U.S. refinance activity triples on low rates, but the housing market's lack of inventory slows purchase growth. So of course, what we're seeing here is we're obviously going to see, a lot of stuff happening, and I'm looking for my right piece of paper to talk about this here. And here it is at the bottom here. All right. So ultimately, in the end, we know as the rates have been dropping, we've been seeing refinances picking up, which is great for people who would like to, reduce their exposure. But what we're seeing, though, is a lot of cash-out refinances. Now, not to the level back in the last housing crisis, but it's picking up, and that's a cause of concern for many economists and analysts as well, too. Despite rise in mortgage rates last week, a slight rise, refinance applications increased 4%. And we're 199% higher than this time last year. All right, purchase applications continue to slow. They slowed for a second week in a row, and they look at it. I guess the people who are talking about this at MBA say, while near-term economic uncertainty is still a factor, other fundamental issues such as a lack of housing inventory in many markets is preventing purchase activity from meaningfully rising. So there you go. So again, refi apps up, purchase apps are slowing down, and that's just a nature of what's going on right now with higher price points, lower inventory, and the economy kind of on teetering right now. People have low confidence in the housing industry and sector. They're not going to buy it. Simple as that. You're not going to do your biggest expenditure possibly of your life when things are shaky. And okay, what do we got here? So refinance share of mortgage activity increased to 62.2%, up last week from 60.4%. So we got over 62% of the mortgage activity is based on refinances. So that, I guess, goes to show you what people are doing. We can say adjustable rate mortgages activity rose 5.5%. Federal housing FHA share of mortgage apps grew to 11.3% up from 10.3% last week. And Department of Veteran Affairs share of applications moved forward to 12.9%. And that's really kind of your major piece of information from the MBA right there. But again, just going back to the whole point, refis are dominating the marketplace, and I haven't talked about it here, but sometimes you see that there are lenders who are going, hey, we need to, lenders cut back on staff, and some of these lenders are going, okay, guess what, we got to hire again. Why? Because of the refi activity. So we're not seeing purchase activity, but we still got to get these loans processed and refi. So it's really interesting how these rates have really changed the marketplace with respect to mortgages and how they've affected the housing as a whole. So that's what you got going on here. So again, refis are over 60% of the activity. So thank you once again for the views. Thank you for your likes and comments. I really appreciate them. Please share the video with your friends and family. I'd appreciate that. And as I mentioned, if you're not already a subscriber, please help my channel grow and subscribe to my channel. Hit the button on the bottom right of the subscribe button, the bottom right of the video here. I thank you very much. I have 2 programs that I'm working on right now. Never Pay Retail, which is my sort of baseline, sort of generic education on real estate investing, how to save money, etc. So I keep working on that. So if you want in, let me know. I know there's a ton of people I got to get back to. Just the real estate market's picking up again down here, and I'm very busy, but I'll get to it. Also have advanced short sale training. This is what I'm really focusing on. We talk about lack of inventory in the marketplace. This is a place where you can go to find the inventory, and nobody touches this market. So please reach out to me if you want more information on that. It's called the Short Sale Cash Connection. You can hit me up at randy@luxuryshortsales.com. Please include your phone number so I can text you and call you, and your email to me. And once again, if you want to see the top 50 housing markets at risk of a downturn, please go to housingbubble2.com. Put your name and email in, click that button, and you'll get it on the screen, and you can actually look at it on the screen, or as I said, click, there's a little download feature, little button, click it, it's going to download the PDF right to your computer, and you can read as you like as you go forward. So that's the scoop on that, so jump on that. And as I mentioned a few times, need help in distressed properties in the following cities. You can take a look at some of these out here, but funny enough, when I looked at these cities, and someone made a comment about this, with respect to why are you looking at Riverside because it's really high priced. Well, we're looking at these things and there's more than one demographic, because we believe that these are locations that will be dropping in the future. And I don't know if you just, if we go back to, some of the increase in foreclosure filings, hey, Tucson and Portland were on that list. So they had a spike in Q3 foreclosure filings. So you see some of these locations when we talk about the foreclosures, they kind of pop up there as well too. And that's why we're not looking to buy, to be clear, we're not looking to get involved with retail priced homes in these locations. We're looking to get involved with distressed homes, and there's reasons why there's a great potential in these locations. So I'm looking for people who want to invest and look for deals. I'm looking for real estate agents who'd like to partner with me and my buyers in these locations as well too. So there you go, guys. So anyway, sorry for the delay in the video. As I said, I've been really busy working on real estate, and we'll try to get another video out this week. It's already Thursday, so probably not, probably the weekend. I have a lot of op-ed stuff I can do that sort of points to what's going on. And like this, I guess you could say like this sort of download that you can look at here, I'm going to start doing more of that, because we can talk about it here, but a lot of stuff that I want to talk about has charts, has more information, more detail that supports the housing bubble and prices and where it's going. And I just go and say, when you look at the trends, so if we go back to the first thing that we talked about earlier, was the recession indicators, and how downturn in housing sales is one of the many recession upcoming indicators, and the fact that housing prices will clearly drop when a recession hits. So just keep that in mind, everybody. So again, thanks very much. Look forward to speaking with you soon.